Hello and welcome to another episode of the Investing with IBD Podcast. It's Justin Nielsen here, your host, and we are coming to you live at 5 p.m. Eastern, as we typically do on Wednesdays. It is September 10th, 2025, and I'm glad to have another just great researcher. I always appreciate someone that loves an Excel spreadsheet, and Eric Krull is one of those guys. We've talked a lot about data and studies, and it's a pleasure to have Eric Krull back on. Eric, of course, is he is the founder of Krull Asset Management, and also one of the co-authors of the Lifecycle Trade. We just had Kathy Donnelly on a few weeks ago, so this is one of the other authors there, and he's got some very interesting data that he's done in terms of the market. So I can't wait to dive in. Welcome to the show, Eric.
Oh, thank you, Justin. It's always great to be here with you. And you're right about we do go hand in hand with doing research and spreadsheets together. And we've gone back a long time and sharing data.
Yeah, and I know I've shared this before, but yeah, one of my first speaking events was at the Naperville meetup, and Eric was right there holding my hand along with it as I did a presentation on. I think it was. I'm trying to remember if it was Daily Graphs Online at that time. I think
It was.
it
Yeah.
hadn't even turned into MarketSmith yet, so
Yeah.
let alone Market Surge. So yeah, it's going to be great to get into it. And you know what? With that said, we're certainly going to talk about the current market, and some stocks, especially maybe some of the IPOs, since there was an interesting IPO today that got priced out. But before we do that, let's get into a little bit of some of the research that you've put together for us. And he's got, Eric comes so prepared. He's got a great kind of number of slides. Some of you may have heard some of this data from our IBD live show. Some of this we have had Eric share on the podcast before. So we're going to go through some of these things maybe a little bit quicker. But let's start with the basics. You went through and you classified rallies. And this is one of the hardest things to do because it's what what qualifies as success, what qualifies as failure. So when someone asks, what is a follow through day and how often does it work? You actually went and said, okay, well, based on what IBD has called a follow through day and the start of a rally, let's look at it. And why don't you share real quickly, or remind folks that have seen this before, what you came up with in terms of your classifications?
Well, I went back originally to the beginning of the paper and had all the data on follow-through days, and also from many of the IBD seminars. You had posted, there were a lot of books given out, and there were more dates in there. And I went all the way back to 1942 using some of my own research to find out what would be classified as follow-through days and how could we classify them in terms of what would be successful or not. And based on some conversations I've had with you and others, we came up with some of things like this. We decided to call rallies into four categories. The whipsaws were ones that lasted 15 days or less. It didn't matter whether the market finished up or down after the follow-through day. If it was 15 days or less, it was a whipsaw. And if it was something that lasted more than 15 days, but the market index gained less than 3% from the beginning, from the close of the follow-through day until the end of the rally, it was a small loss or gains, or we call them slogs.
Mm-hmm.
If it was something that lasted more than 15 days, but the market gained in the index from 3% up to 15%, we called those money makers. Now remember, these are the index changes. Individual stocks can change a lot more than that during that
Yes.
rally. So it may sound like a small amount to gain between 3 and 15%, but an individual leading stock, that might gain anywhere from 20, 30 to 40% in that kind of a time frame.
Or
And a
more.
life changer
Absolutely.
rally, and a life changer rally was one that was more than 15 days and more than 15%. So that's kind of like the 15-15 rule. It had to be longer than 15 days and gain more than 15% from the index viewpoint. And that's where you made some really big gains in individual stocks. Sometimes those gains can be 20, 30, 50, 100 to 200% during life changer rallies.
Mm-hmm. And so when you're measuring this, you said from the follow through day to the end of the rally. What qualifies as the end of the rally? Because I can always tell where a top is if you just let me go a few months, afterwards. But so how are you doing this for your research?
My original study was based on when did the Investors Business Daily say market in correction. Sometimes they would say under pressure, but as far as I was concerned, the rally was still going. It was
Yeah.
when IBD either said in the newspaper or when they said online in the market pulse, if they said market in correction, that's when I said the rally's over.
And then when you say gain, were you measuring from the follow through day to the gain at the time that it went to correction, or where it went to at the peak?
Those numbers were at the time the market went into correction, so the last day of the rally. The
Hmm.
numbers for peaks were a little bit higher. On average, it's about 5% higher than what that happens at the end day close. But I would measure those for when you guys said the market's in correction, that close on that day.
Yeah, and that kind of lets you know that you had enough time to get out of the market. Because I mean,
Yeah.
if you have a crash, then it's a little bit tougher to call that a life changer if you didn't get a chance to get out and it
Yeah.
just crashed on you.
Yeah, the wrong kind of a life changer.
Yes, exactly right. The regret, the regretful change.
Yeah.
So now that we have those definitions, again, one of the greatest things is that you kind of said, okay, well, how often do these happen? And so if you could just share this slide real quick for folks.
Well, let's just summarize it quickly this one way. It's about a 1/3 green, 2/3 red scenario,
Yeah.
which means about a third of the time, the follow-through days produce rallies where you could make money and do really well. And 2/3 of the time, you either didn't make money or very little with a small loss or gains, or you lost money with a whipsaw. And
Hmm.
so if people want to think of it that way, follow through days produce rallies where you can make money about a third of the time.
Yeah. And I just want to stress again, because it's one thing to be looking at the indexes as your guide, but individual stocks are kind of where you're making your money. And this is where the risk management comes in place. Last week we had Mark Ritchie the second on from Minervini Private Access, and you know he was very honest about you can be right 33% of the time and make a fortune as long as you're making those decisions that when you're not making money, you cut your losses quickly. So don't be disheartened if you look at this pie graph and you're like, what, a third of the time? That's it? As long as you're cutting your losses when you're not wrong, when you're not right, when things aren't going your way, you can really really supercharge things when you are right. Losing a little to gain a lot. And let's just put today's rally in context. So you actually provided this almost at the close, but very late in the day, intraday, in terms of where we are here on September 10th, 2025, versus the average. So we've got the red is the current rally starting from April 22nd follow through day, and then you've got the averages of all these different ones. So talk to me a little bit about how different this rally is, or is it just kind of like in its own little special 1% kind of thing?
Well, the way I use this chart is in such a way that when a follow through day happens, I start plotting the top red line, and I want to know, where does this rally compare to the past? And if it's above the green life changer line, you start to get excited, and I start to get a little bit more aggressive in how I invest. If instead that line starts to go below life changer and is near money makers, I'll probably still be aggressive and maybe not as aggressive. Or if I see it running along the slog line, and especially if I see it near the whipsaw line, I'm not going to be so aggressive. I might even lighten up. And the whole idea is we'd like to know when a follow through day happens, what kind of rally is this going to be? And if I start charting it versus the historical lines there, you get a pretty good idea right away. And this
Hmm.
chart shows the first 25 days of a rally after a follow through day. And you can see the whipsaws, well, they end in 15 days or less, right? So that line's going to stop at 15 days. But you can see those other lines, and how did this rally stack up? Well, I knew pretty early, within the first 5 days or so, we were way above the top line of a life changer average. And so I thought to myself, this looks like a good rally. So I started to get more aggressive with my investing. And that's
Yeah.
how I tell your listeners, if you can do something like this and just start plotting it, you could take a screenshot of this and start plotting, how's the rally going? You'll know, how is this rally shaping up?
Hmm. And do you find that there's any clues, because we're going to be talking about the pullbacks and the corrections, but do you find that there's any clues in terms of the correction? There's often that kind of feeling that the harder you come in, the the better the bounce a lot of times. And that was certainly the case with COVID. We came in very fast, very hard, and when we did get the April 2nd follow through day on the S&P 500, April 6th follow through day in 2020 on the Nasdaq, it was a really powerful rally. Probably on a similar trajectory above the average as this one is. So do you ever look at, oh, this correction is such that I would expect maybe an even better than average life changing type rally?
Sometimes you can have that expectation, but in general, I have found it's really good to just compare it against not only this graph, but also some historical ones. For example, we had one last August, if I recall. We started out pretty sharp above the life changer line, and then slowly but surely it kept decaying. The index wasn't going up as fast, and it started to come down to the moneymaker line. It went below the moneymaker line for a while. And so it was one of those things where we started off high and we looked like we had a sharp bounce up, but then it started to fade. And so that's one way to look at it too, is like you can expect that it might be coming up fast, like a post-COVID or a post-tariff Liberation Day bounce, but you really need to just keep watching it and compare to history and know that it doesn't always have to be that way.
Yeah, so almost trust but verify, I guess. You
That's
can have your
exactly right.
thesis, but wait for the data before you do
Yeah.
too much. And yeah, that totally makes sense. And then kind of moving on here, also in terms of length of time, where are we at right now?
And this graph shows, especially the blue line there, that shows you how long rallies typically last. And if you look at the right side scale, you can see that rising up toward 100%. And along the bottom are the number of days. We are 97 trading days into this rally. And by now, almost, I think it's like 85, maybe 90% of most rallies don't last this long. So this one is pretty long in the tooth. But I've also marked two dates on there. The average age of a moneymaker rally is 66 days, and the average life changer rally goes 140 days. Well, we're 97 days into it, so that's another sign we're in a life changer rally, right? But it also shows that we could go another, 43 trading days, which is 2 more months, and that wouldn't be, unexpected. And
Yeah.
I don't use these graphs to make decisions to predict the market. I use these graphs to be aware of where we're at. So, for example, I know there could be 43 days more to go for the average life changer, and it just makes me think to start thinking about if I have a stock with really big gains and the stock starts to pull back, maybe that's a stock that I need to either hedge or maybe lighten up a little bit on the number of shares. I don't use these to predict and then do things preemptively, but I'm always aware that those exist and where we're at.
Yeah, that makes total sense. Now, uh, and I also want to just reiterate kind of what you were saying here. This is a histogram, a bar chart of all rallies. So when you really kind of think of where the average would be for all rallies, it's very different than that 140-day average of life changers. And I mean, that's sometimes how they get to be life changers, right? It's the
Right.
length of the rally that, kind of allows you to make more money. It's, when you get this flash in the pan, and I mean, I'm thinking back to some of those rallies that we had on the Nasdaq back in 2001, 2002. They were powerful, 40% moves in the Nasdaq, but they were so short. It was like you blink and you miss it type thing.
That's right.
So, okay, and then also let's also just talk a little bit about some newer information that you're providing here, and this is using a 5.5 ATR. ATR, of course, is average true range. This is something that a man by the name of Wilder came up with. Gosh, 50 years ago, I think almost. And it's basically looking at, okay, how much does this move on a daily basis? Now, you're using a 50-day moving average, and you're also saying, oh, when you get extended a certain amount, then it's a time to be careful. So how did you come up with 5.5 here?
Well, what I did was I took a 50-day moving average of the ATR, the average true range of how much the index moves, and I started plotting it on the graph above the regular 50-day moving average. I said, well, what's one ATR above the 50-day moving average? And then I did 2 and 3, and I kept moving up. And then when I found, when I take 5.5 times the average true range of the NASDAQ index and added that to the 50-day moving average, a funny thing happened. I noticed that the market started to pull back when it would touch that line. So that black line on top is the line I plotted, and you can see in multiple occasions when the index like kisses that line, or even sometimes goes slightly above it, the index starts to correct. And it happened this year multiple times, and most recently just a month ago, and it did it like a month prior to that. And so, how do I use this? I look at that as one more piece of information. Again, I don't preemptively sell things when I see it's getting near that line, but I do notice that if it gets near that line and the market starts to pull back, well, maybe that's a reason for me to lighten up on a few stocks, or in some cases, just buy puts and hedge. If you look at that line where it touched recently, a red bar, the one right there, we opened up really high, way above that line, and on that day, the market started pulling back ferociously, and my stocks were getting hammered. And I started to buy puts right away because I was like, I'm aware of that line. I don't like how my individual stocks are acting. Now's a good time to act. And then look at that very next day, that huge gap down. And I was so glad I had some puts, because that was a huge kick to my portfolio, kick in the pants, I should say. And then it started to come right back. And once again, rallied back up to that line, and then it got weak again. So it's just something to be aware of. And I like to look at it so that I'm just aware of history, and I know how to act. It gives me an idea of what I should be doing.
Yeah, and again, it tells you what kind of environment you're in. It's letting you know, oh, yes, this is a more extended environment. It might not be the time to start. Uh, you know, oh, now let's get aggressive.
Right, right.
It's one of those things where it's like, oh, now let me just look a little bit harder. I find that too. Like if something goes above a channel line, it might not be a climax top, but I'm going to look to see if it's a climax top. It just kind of lets me know to look a little bit harder for those sell signals.
Yeah, you brought up a very good point. When it gets near that line, my buying window was closed. We're into the rally a long time. It's getting extended. I'm not going to be going aggressive and buying new things at that point. That's a time instead to lighten up, I think. And we'll see in a future slide that there are times when it goes above that line and it stays there for a while.
Yeah. So I feel like with these slides, you've really laid the groundwork in terms of the rally side of things. And let's just go through a couple of these examples with this 5.5, since this is newer for our audience. If those folks hadn't seen the IBD live show, but here is back in 2022, 23. So this is coming out of that 2022 bear, and things were starting to work. And this one really had quite a bit of time, actually, a little bit more of that extension above that line.
Yes, and you would have been a little bit heartbroken if you decided, oh, I watched that ATR line because Eric said watch it, and I started to sell preemptively because it always works, and then sure enough, it didn't work perfectly, and you probably left some gains on the table. And then it did start to correct, and then went right back up to that line, and went over it again a little bit, and then it started to come back down and correct pretty hard. So again, it's just something to be aware of, but I would certainly think all the times when it gets above there, that's a time to say, I'm done buying for a while. I can sit where I'm at, watch my individual stocks, see how they act. And then if they start acting poorly, then you start to hedge or you lighten up.
And I just want to maybe address real quick, because this is a good example of, okay, yes, you did get extended here. Yes, you did have the pullback, but it wasn't the end of the rally. You got support at a level. So we talked about maybe the buying window being closed, but do you open it back up? What causes you to open it back up? How
Yeah.
much of a pullback or what conditions have to be there for you to say, oh, you know what, I can actually take off my hedges or get a little bit more aggressive now.
Yeah, that the bounce off the 21 EMA, the green line there, that's a sign. And I'm sure if you watch your individual stocks, you might see
Right.
that they're bouncing too. And that might be a time to say, okay, I'm selling my puts. They did their job. Or if you had lightened up a little bit, you might start buying back that stock you lightened up on if it looks good, if that individual stock looks good.
Yeah. And I'm just going to make the contrast here because, yes, you did get back above that line. Yes, you did have another pullback, but man, it acted differently at the
Yeah.
21-day moving average line that time. So you had, that feels like to me, you had plenty of time to act and say, okay, now rather than doing maybe some aggressive buying off the bounce, oh, I just have to do some more aggressive selling. So
Yeah.
maybe in addition to the puts that you have, oh, you know what, I'm also going to raise some cash and really kind of exit some of these positions as opposed to trying to see if they get support.
And I wouldn't be surprised at all if that second pullback, IBD went into marketing correction right about there. So that's another sign. There's more to it than just this. And I'm sure individual stocks started to look terrible back then.
Right. Looking at another example, I mean, 2003, as we mentioned, you had a 79% correction in the NASDAQ with the dot-com crash. And 2003, when we came out of it in March 2003, it was a very powerful rally with a number of these touches of that 5.5 ATR above the 50-day moving average line. But again, for the most part, they did seem to get support, not at the 21-day. Sometimes you had to give it all the way to the 50-day, like here in August, and it was actually a few days below. So how would you kind of handle something like that where it looks like, oh man, we could be getting into trouble? Um, how aggressive is your selling there, and when do you start looking and saying, oh, okay, no, it's everything's going to be okay?
I remember 2003, and back then I wasn't buying puts for hedges. I didn't trade those back then, and
Uh,
I do remember being shaken out of most everything I owned when it went below the 50-day moving average. And then when it went back above it, sure enough, we had a follow-through day soon after that, and I started buying back. And I was a little timid at the time buying back because it had been a pretty harsh correction. But then I got more aggressive as my stock started working. But yeah, so I was certainly pretty much shaken out of everything back in 2003 at that time. And I was looking at individual stocks again and how the market had a follow through day. And that's what made me get back in.
and look, there's always that balancing act. You can be more aggressive on your selling earlier, but then, it means that you're probably going to be buying back and possibly at higher prices if you do rally, but the earlier you sell, the less of a drawdown you get. But it's harder, it's easier to get shaken out of things and not get those big 100% gains as much.
Yeah.
Another one here, 99 to 2000. Look at how much time we spent above the 5.5 ATR. I mean, that really kind of shows you how different this rally was.
We definitely had to show this one because that was the internet craze, and you can't possibly look at an indicator unless you try to see it in a time frame like that. Way back in '99, it looked like it touched the line and came back, but then when it burst above it in late '99 and then stayed above it for a long time, that certainly gives you the information that just because you touch the line, don't sell everything because you can be above that line for a long period of time. And look at that rally you would have missed out if you decided that I'm going to use that one line as the end all and be all as an answer.
Yeah. And here again, your individual stocks, while you might have been looking for sell signals, a lot of them looked just fine. It wasn't until March that they really started looking very climactic, and we can see what happened shortly after March 10th. Okay, let's talk about pullbacks. So in the same way that you kind of did this really cut and dry, it's in this category, it's in this category, which I really appreciate. You did the same thing for pullbacks. So maybe kind of just tell us how you classified things.
Well, I decided that I knew a lot about rallies and not enough about pullbacks. And I'm going to call them pullbacks because if I call them corrections, it uh, kind of interferes with how some people in the media talk about the market coming back into a correction. And so what I decided to do was use my data and now start to track from the time IBD said market in correction, and you mark that day that says go into correction, get that closing price. And then you follow the market and you follow prices and you see how does the market move until you get into the next follow-through day. And then the correction's over when you get a follow-through day. And so I measure the correction from the close of the day that the correction starts to the bottom low that occurs before the next follow-through day. And we take the numbers and look at the number of days and we look at the price change. And I came up with some classifications for that too.
And so when you're, well, let's get into that, and then maybe we'll kind of talk a little bit more about this. So here's your 4 categories in terms of your pullbacks, and in the same way that you had the whipsaws after a follow through day, those whipsaws are part of your pullbacks too, right? Where you might have a pullback that just doesn't really last; it comes right back, right?
Yes. And remember, this is not from the peak. This is from the day the market goes into a correction. So you've already come down off the peak in most rallies. And so you can find that the market might go into a correction according to IBD. And then you say, well, how long did that last before the follow through day? And many times it's 5 days or less. So we're going to call
The worst
those
is when it's the
whipsaws.
very next day.
Right. Sometimes
Oh,
it's
market in correction. Oh, okay. Now we're gonna move higher.
right.
Yeah.
And so no matter how much the market goes up or down in those 5 days, it doesn't matter. We're going to call that a whipsaw. If we have a correction, or I should say a pullback, that lasts more than 5 days, but the loss is less than 10%, then we're going to say that that's a mild pullback. Now, it may not feel mild for you and your portfolio based on your individual stocks, and also remembering that you've already are down from the peak anyway. But
Yeah.
from the time the correction is called to the time that the next follow-through day, if it's greater than 5 days, but the index loses less than 10%, we're going to call that a mild pullback. If the pullback goes down more than 10%, now the press, both media and TV and newspapers will say the market's in a correction. So I'm going to call it a correction because if it hits that 10% point, you're going to hear that on the news. They're going to call it a correction. If you get down more than 20%, they're going to call that a bear market. And so I'm using the same categories here. Now I'm measuring again from the day the correction starts, from what IBD calls, not from the peak. So you might even hear on the news it's a bear market before it would actually meet this criteria. But these seem to work pretty well, and it seems to fit pretty well with the study.
Yeah. And so now for decades we were using the market in uptrend under pressure, market in correction. That started actually in March of 2003, right around that follow-through day. Just before that follow-through day is when we started using that designation. Now we're kind of doing a little bit more of an approach where we're saying a range, 0 to 20%, 20 to 40. Is that changing how you're kind of using this, or are you saying, okay, when they go to 0 to 20, that's the correction?
You nailed it. When you go from 0 to 20, that's when I say that's when a correction starts.
Okay, perfect. Okay, so now that we have our classifications, because again, that's important to figure out first, what did your data show in terms of pullbacks?
Well, it's very interesting in that you find that there are very few pullbacks that can really hurt you in terms of the overall market. So you're looking at bear markets are about 3.2% of all pullbacks. Corrections are about 5.2%. So when you add those up, you're looking at just under 9%. And then the rest of them are mild pullbacks or whipsaws. And so when you have that, you should know that when the market starts to pull back, you shouldn't be worrying about here comes another bear, or here comes because they don't happen that often. Between whipsaws and mild corrections, they end up happening about 4 times a year, so about once every quarter. And so that's something you should know that, okay, the market might be doing really well. And if every, 3 months we get a little whipsaw or a mild correction, that's normal. And you don't freak out, okay?
Hmm.
And corrections happen about once every 3.5 years, and bear markets about once every 6 years. And in this case, the most recent time, we had the COVID bear market, which is in 2020, and then we had one this year, which was just over 5 years later. So is it every 6 years? No, not exactly. It averages every 6 years.
Right.
But you just need to know that the corrections in the bear markets don't happen as often. So don't be afraid all the time and keep dumping everything just because you think, oh, this is the next bear, this is the next bear. They only happen like every 6 years or so.
Hmm.
But
What about 2022? Because again, that felt very punishing and long, like where it just, nothing was working. But you had all these kind of rallies that fizzled, and they were happening under the 200-day. So, I mean, how would you classify those? Because again, there were all of those false rallies. So, did that count as a bear market or not?
that would I'd have to go look up on my data, but I would say it probably, if it didn't classify as a bear market, it probably was because there were individual pullbacks that never got up to 20% for any one of them. But if you add it up over the year, you might have
Right.
had, it might have occurred from the absolute top to the absolute bottom was probably over 20%. But I'm guessing there was no individual pullback that ever got to the bear market level.
Yeah, and that's a tricky part because sometimes when you get in one of those punishing like 2022, you have a lot of rallies. And I mean, this happened in 2001 to 2003 as well. There were all these rallies, and it might have kind of made you feel like, oh, you kept on getting drawn in. And I would also maybe say, as you kind of said, don't be so afraid of the boogeyman bear market around every corner. But there's a lot of these that are these mild, and the correction phases where you do still have to be careful because if there's a lot of back and forth or these false rallies, that's where I feel like you can get hurt. With the rallies that don't work, that kind of lure you in. And again, if you're going in too heavy too quick, or you are allowing allowing yourself to take bigger hits, maybe trying to adjust your stops and give things more room, you're gonna have a bigger drawdown.
Yeah, if you are too aggressive and getting back into the market in a year like that, that would be like the death by a thousand cuts, right? You
Yeah.
keep getting enough 2 and 3% losses, or maybe some 5 and 7% losses. It adds up if you're too
Hmm.
aggressive.
And I can speak to that from experience. Back in 2001, 2002, it was like I had discovered margin and then kept on using it when I shouldn't,
Yeah.
because it was like I was trying to get 99. I was trying to party like it was 99 again, too many times. So as you kind of classify these, it kind of shows you how this kind of plays out. So explain this chart in terms of your pullbacks.
What I'm looking at here is I took for each pullback and I classified them. I then looked at the first 25 days of trading, or first 25 days of price changes in the index for each category, and came up with these lines. And it's nice to see them separate like this. You never
Yeah.
know how it's going to separate out. But you can see that the bear markets tend to have some price changes in the index that are more substantial than the ones that are the corrections, and certainly a lot more than the pullbacks or the whipsaws. It's interesting I was surprised to see that in the whipsaw phase, those actually ended up with slight gains in the first 5 days, and
Hmm.
versus the other ones where they all had losses. So this would be the type of thing where, again, you start a pullback and you can plot this and see, how am I comparing? Am I looking like this is going to be mild, or is this looking more like a correction, or is this looking more like a bear market? So it's nice to have this information so you can compare it.
Yeah, and I'm just gonna shout out to Tech One Trades in the comments because he makes a very important point here. Corrections and bear markets are gifts. A lot of people don't think of it that way, but it really is. I mean, when you get something that is that punishing, I feel like it's easier to stay out a lot of times because things are so bad. And I mean, the fact that that purple line is down so much so quickly, it's like, oh yeah, I want no part of that. That's the easy one to stay out of. I feel like it's the ones where it's like it suckers you in. Those are the ones that can be the most difficult.
Yeah.
So
I
yeah, very
remember
good point.
I remember Bill O'Neill once saying about shakeouts in individual stocks. He said, they're not hard unless you're in the stock. And the same thing with the
Right,
market.
exactly. Yeah.
A correction in a bear market's not hard unless you're in the market really
Yeah.
heavy.
Uh,
So,
well, and everyone talks about like, oh, um, the buying opportunities that happen, when there's blood in the streets and everything. Well, that assumes you have cash to buy stuff with, right?
right.
People forget about that part. They say, oh, everyone's saying, oh, market timing is a fool's errand. You got to buy when there's blood in the streets, and it's like, well, how do you get that cash? Unless you have done some selling and some type of market timing. So yeah. Um, and what are we looking at here in terms of the results and findings?
This is just a summary of everything so far. I'm trying to show you what the average length and trading days of each of these rally types are, and then how much of a pullback you have at the end of the rally. But the one to really look at is on the far right there at the bottom low. So a whipsaw, you maybe lose only 1% or so, and a whipsaw at the bottom. A mild pullback, the index is down 5%. A correction, you can go up to like 19%. And then a bear market, you're looking at, you can go down as much as 31% on average for those type of pullbacks. So you really need to be aware how fast and how far it can go. So I had showed the number of dates in the first column,
And that's
and on
with
the
an average length of 59 days. Like
yeah,
that's
yeah,
that's just like what, 3 months, a quarter?
yeah, trading days even. So you're
Yeah.
looking at 3 months for a bear market. Yep, that's the
Yeah.
average. Not
Hmm.
very long.
Yeah. So man, that's yeah. And again, this is where it's important that if you can avoid that, um, just think of what that can do to your portfolio. If you don't take that much of a drawdown, what that can do to your portfolio if you're participating in the rallies and there's no way to sidestep the entire thing. But if you can lessen that, wow, what kind of power you can get from
Yeah,
that.
and think about this year, the market pulled back 23% in the Nasdaq, and if you look at some of the leading stocks, maybe I think Nvidia got cut in half. It lost 50%. So
Absolutely, yeah.
the index lost 23, the Nvidia lost 50%, and there's many other stocks like that this year. I forget
Yeah.
what Palantir lost and a few others, but
Yeah,
yeah,
but 50% was not like out of the ordinary. It
right.
seemed like there were a ton that were 50% plus. Okay, so we've got the cumulative frequency. So what is the cumulative frequency?
Gives you another idea of a way to look at it. Like when you're into a pullback and you start to look along the bottom axis, like how many days into it, this gives you an idea of when the pullback should be over. Because when there's a pullback, it feels like, oh, this is never going to end. But
Yeah.
you can look at the number of days at the bottom and see that, well, about 3/4 of them are over in just 20 trading days.
Hmm.
And, that should give you an idea of like um, how long you can be away on vacation or how much you can stop
Right.
making a watch list. You
Uh,
would see that they don't last very long. If
mhm.
most of them last, and most of them are over within 20 days, 25 days, you better be ready. You have to
Yeah.
have your good watch list in shape and know that these pullbacks don't last forever. The market comes back, and this just gives you an idea of how long they last and how often and what percent of them are over by the time you get to a certain number of days.
Hmm. Yeah, that is just absolutely such an important point. We always talk about how you need to make sure that you don't get complacent, and that you're always ready. So yeah, maybe you can take off. You can have a week of complacency, and then
Yeah, and don't get despondent, and don't get
yeah.
you know people give up.
Yeah, and it gets back to that point that we were making in terms of bear markets and corrections are absolutely gifts. You have to look at it that way. That was one of the things I learned most from Bill O'Neill was how optimistic he would be. during bear markets. The sun will come out tomorrow. Don't throw in the towel. Keep on going. You can do it. Because he knew how many people gave up because bear markets and that feeling of, oh, it's never going to work again, when that was just nothing could have been further from the truth. So I want to shift here, and we still have a little bit of time, and because you are one of the co-authors of the Lifecycle Trade, I wanted to kind of get into some of the IPOs. And for those that don't know, the Lifecycle Trade is really very heavily focused on understanding how stocks begin, how they kind of go through these different phases, and then how they get into their winning phase. So I shouldn't say all stocks, because it really is, you guys are focused on the winners, the ones that are great, and what those look like. And to that end, we had an interesting IPO today, Klarna. This is something that I feel like this is an IPO that we've been talking about potentially for a long time. I mean, it was, I feel like they were talking about this coming out in 2021, when everything was coming out as an IPO or a SPAC. And then it dried up, and Klarna, I think wisely, decided, oh yeah, this isn't the right time. But now we've got Klarna trading, and talk to us a little bit about that first day of trading for an IPO and what you should do.
Well, first, you're right about this stock being rumored to go public for years. And it's been on my list of stocks to look for a long time. And for whatever reason, they decided not to until now. And this is pretty typical for an IPO on day one, especially this year. I don't remember what the offering price was from last night. My guess is that it was much lower than where it opened. It looked like it opened somewhere, above 45. And
I'm
it
thinking
might have
30,
even opened
35,
higher.
37.
Yeah.
Does that sound right?
It's possible. I didn't look into what the offering price was, but it looks like it went up as high as $57 a share, and then it closed at 45. Market Surge doesn't say the open price, but my guess is it was probably in the higher part of the range when it opened, and then it closed at $45.82 a share, and look after hours, that's maybe right near 45. We always say we the authors of the Lifecycle Trade, be patient, never buy day one, because this is pretty typical, where the stock will have some wild vacillations on day one, and most of the time the stocks undercut their day one low within 3 weeks. When we did our original research, it was 55% of the time stocks undercut the day one low within 3 weeks. This year, IPOs, it's 91% of them have undercut their day one low at some point during this year. And so let's pull up Figma, FIG. That's a stock that has a similar pattern on day one. Look at that big bar on day one. It went even higher on day two. But look at that within days, you've undercut the day one low, and it's gone much lower than that. And it really had a big gap down just the other day, and now it's below 50. So this is why we preach patience, because if you get excited, you see it on TV or you read about it in the paper, oh, this stock's going public, oh, it went up 50% on day one. Look at that offering price, was $33 a share, and it went over 100 on day one. Those people who got it last night at 33, that stock's like at $115 a share. Oh, I missed it. I'm buying it now. And look what happens. You got in what's considered late because you didn't get that offering price. And look how much money you would have lost. So that's why we preach patience, because most of the time the day one low was undercut. And then the stock will go sideways for a while and then form some sort of base. And then you can buy after a base. But in this case, it hasn't formed a good base yet, and you're still out.
And I should also mention that's in the good cases or the great cases. A lot of these, you forget about them because they just go into the dustbin of history.
Yeah. Pull up Bullish, BLSH, another one that had a great run, and it was all over the news about, oh, what an unbelievable. It was offered at 37 the night before, and it goes way up above 100 also. And then if you get too excited and you buy the hype, you might buy in day one somewhere, and within a day or two, everybody who bought on day one has lost money. and here we're at 52. It hasn't formed any kind of base yet. This is pretty typical for how IPOs act. That's why we say be patient.
And another one that was that you brought up was Chime. This was another one that a lot of people were looking at, and there were some of these signs of life. So if
Yes.
you had said, "Oh, I'm going to be patient," and then you got this reversal here, and it starts rallying, and I mean, I could see in either one of these really looking at this and saying, "Oh, this is something maybe I can do something with."
And you're right. And you definitely could have said, well, we talk about like the hook pattern. My co-author Eve Bobach has found the hook pattern. It works pretty well. But what we do with IPOs is this. You never go big in an IPO because they're more volatile. So you go with a smaller size position. And let's say you bought that hook pattern and then it undercut it. Well, you know where to get out and you can keep your loss small. And then with a smaller position, you're not hurt too badly.
Yeah, no, that totally makes sense. Now, we're looking at a lot of these stocks that are so recent in terms of their IPO that it's kind of hard to see how some of these are going to turn out.
So
We don't know at this point. But let's take a look at a IPO, a fairly recent IPO. This came out in 2024, and this is Astera Labs, a lab. I do have a position in this, so maybe talk about how that patience would have potentially paid off here with a lab. And I'm just gonna real quickly go back in time on the daily chart here, and you know. This is one where it didn't come in. The people that bought on day one were like, "Oh, this is great because on day four, I'm already making a lot of money."
yes, and I will disclose I own some shares in this stock too. Yes, in the beginning there, we call that the IPO advance phase, where it first comes out and it starts to rise. And this one went up only looks like 3 or 4 days, and
Yeah.
then it hits a peak and then starts to correct, and then it starts to form a base. And pattern recognition there shows a cup, and it looks like it's ready to break out of that cup, and it tries to, but it never gets above that day or that first high, which was like on day 3. We call that high the turbulence zone. And that's an area where you can buy once it gets above that. And in this case, the cup never really was like it didn't break out. We didn't have the breakout of the cup. And then it starts to correct and it goes down and down and down. And sure enough, it undercuts that day one low, like 91% of all stocks. And you probably never even got hurt because it never had the breakout. So if we go further ahead in time, like you're doing, you can see that it forms a nice long period where it's undercut the day one low and it's going sideways. We call this the due diligence phase. And we call it the due diligence phase because you probably go 2, 3, 4 quarters where they start to report sales and earnings. And do they grow into the earnings and sales that they promised when they did the roadshow and when they did the S1? And you can see that institutions, they can start to buy it if they start to get the good sales and earnings growth that they expected. And you can see that gap up. It's above that 70, 74. Yes, right there. That was a sign you could buy. I believe I bought this one just below that 70, 74. There was a gap up there before we hit that 77.4. $70.74. Yeah, because it had a long period of due diligence, a nice tighter base, a nice tighter action. And then when it gapped up, that was a place you could buy. And then you could add when it does the second gap, and it runs up, and it runs up very nicely without too many bad shakeouts all the way up to the 147. And then at some point after the 147.39 peak, you're going to find an area where you want to sell. There's that huge gap down at the 50-day moving average. That is a definite sell sign. And then you could be out, and now you watch it again. And this was an area of a time in the market that the market wasn't acting very well. And sure enough, you're looking at another long due diligence phase, and then it starts to break out further along on the right side. And now we're going to call this the institutional advance phase, because now the stock has been trading for a couple years, and it has a nice tighter pattern. The bars are a smaller range, and it breaks out and it starts to take off. And I did buy some when it broke out there, and it's acted pretty well since then. It gapped up again way back in late July. That was another place you could add. And then it went sideways for a while. And anybody who added in late July, you might have gotten nervous. And then sure enough, it breaks out right above that red line you drew there, and it's taken off again. So that's one way to trade this stock. You know about the IPO advance phase, you know about the due diligence phase, and then you look for the institutional advance phase, and that's really the place where you can do well.
Yeah. Now I have to admit that I bought this here and then I sold it. I think I might have bought it here and definitely bought it here. And I think I sold on one of these days, missed this move. And so for me, it was kind of like, oh, how do I get into this thing? Um, so when something comes up that strong, you don't want to chase it. You know, you don't want to chase it
Right.
necessarily up here. But how do you get into it?
Well, that's a hard thing, and what you did is somewhat typical, where you tried a few times and you took the small loss and got out to protect yourself. You know, you're never sad when you take a small loss and it moves on beyond you, because that's okay. It's like the fire insurance. You're
Yeah.
okay with paying the small amount of money on the premium for the insurance. If the house doesn't burn down, you're not mad you paid the premium, right?
Hmm.
Same thing, or if I should say, if your house doesn't burn down, you're not mad you didn't pay the premium. It's okay. You're glad you have the insurance.
Yeah.
In this case, uh, the only way I think in this, if you've gotten shaken out three times, if you bought three times and got shaken out three times, it's hard to buy that gap. But I would recommend at that point you do a smaller position and see if you can
Hmm.
hold through. Because if it keeps shaking you out, then maybe it's too much pain. So maybe try a smaller position.
Yeah. No, that's a very good point. Oh, well, Eric, as usual, it was wonderful having you on the show. Really appreciate you sharing that brand new research. So, folks, you saw it here first. And yeah, thanks for all the work that you do and how much you share your knowledge with everyone. Again, for those that don't have the book, uh, Lifecycle Trade by yourself and Kathy Donnelly, who we had on the show, E. Bobach. We haven't had Kurt on. I mentioned that to Kathy.
We've got to
Uh,
get Kurt.
yeah, so we'll get him on eventually. But that's some place that folks can check that out. And also on X, you share some of this information at Eric Krull One. Is that correct?
That's correct.
Yeah, perfect. Well, again, Eric, really appreciate you coming on the show and sharing this stuff. Always great talking to you.
Thanks, Justin. It was a pleasure being here. Thanks for having me on the show. And as always, it's always good to talk with you about stocks on the market. It's fun.
Yeah, yeah. So I'll be diving into some of those data points, and we'll probably chat more about it down the road as you finesse and fine tune this. So really appreciate it. That's going to end it for us this week. I'm excited about another new guest that we're going to have on next week. If you've heard of the 4% retirement rule, then you are probably looking at the research or recommendation of Bill Bengen. So we are going to have the man himself that came up with the 4% rule, and he's going to share with us why it might be closer to 5% now. So we can't wait to have him on the show. Hope you join us for that. It's going to be live at 5 p.m. next week on September 17th. Join us for that. Thanks a lot for watching this week. We'll see you next time. Bye now.